the current obsession appears to be about cutting rates in the United States. And importantly, those have been dramatically reduced since the start of the year. Our next guest, who's bullish on equities, is bullish even if, as he says, we might not get any rate cuts this year. Michael Antonelli is managing director and market strategist at Baird. Michael, thanks so much for joining me. I'm so glad we can have this conversation because I keep asking people about the risk that we don't get any rate cuts this year. What probability would you assign that?
I think it's a higher probability than most people think. We've talked about rate cuts or no rate cuts, like you said, for the better part of, I don't know, at least the last 6 to 12 months. I am of the opinion, Amber, and I put this out there as a strategist, that I don't think we'll get any rate cuts this year. And I don't think that's a bad thing. I don't think that the U.S. stock market will struggle. It's currently accepting that fact right now. As we speak, the odds of the odds of a cut in June and in July are starting to be priced out a little bit. They're still 50-50 for June and maybe 30% chance for no cut in July. But I don't think we necessarily need them, Amber, and that's super important for people to start to think about.
Well, explain why that is.
Sure. First of all, we have to say, why is the U.S. stock market going up? Okay, let's just make this as simple as we can. Why is it going up? Well, earnings estimates in the United States are rising. If you were to look at 12 months forward, they're at about $250, which is the highest they've ever been. Earnings estimates are going up, not because of rate cuts, but because U.S. companies are really good at one thing, and that's making money. They make money, shareholders make money, the indices continues to go higher. So we are underway with a reflation trade in the United States. The sectors that are leading are not just tech. We're talking about energy. We're talking about materials. We're talking about financials. These are reflationary trades. This is a no-landing reflationary economy where we don't need rate cuts. We just don't. We talk about it way too much, Amber, way too much.
We definitely do, and I agree with you there. And I also feel like we talk about inflation getting back to 2% as if that's the goal for everybody. But corporations, part of why those earnings estimates are going up is because 3% inflation is kind of a nice sweet spot if people have jobs and are employed.
That and the housing market in the United States. I mean, the housing market in Canada is obviously a big discussion. I'm sure you guys talk about it all the time. So
all the time.
Same thing in the U.S. The housing market is super critical to the bullish narrative, and that's because for most people in the United States, a home is their primary financial asset. So when the housing market stays strong, economic activity stays strong, animal spirits stay strong. So 3% inflation, yes, it keeps people's home prices going up. It keeps them quite actively engaged in the stock market. It keeps them engaged in the economy. So all this stuff leads me to believe that 3% inflation might be the floor for a little while. And I think that's going to be okay. I don't think that's ideal. Most Americans want prices to go back down, if not fall. But if we can land in the low threes, I think that'll be okay.
Your worldview probably still favors tech, probably favors those cyclicals that you mentioned, but probably does not favor some of the more defensive sectors that you typically go to, like telecom, utilities, staples.
Right, those interest rate sensitive sectors, correct. Like I am a big fan of staying out on the risk curve. I think you can do very well in materials. You can do very well in consumer discretionary, financials. I don't think you need to seek out the safety of staples and dividend players. And I think you can stay pretty far out on the rate curve. In the risk curve. But I do watch things that will lead me to be a little more nervous. If the 2-year note in the United States breaches 5%, if we start to get rates inching higher, then I will start to get worried again. Does that mean inflation is perking up? So I do paint a rosy picture because I think it's necessary to talk about that and necessary to remain bullish. But I do also have my eyes on things that would make me come back, Amber, and give me pause.
So are those things in the bond market? Is there you mentioned the 2-year yield? Is there a certain level on say the 10-year or even on oil prices, right? Like that is inflationary. That's a real cost that, Fed heads might be able to adjust out, but everyday people can't adjust out their gas costs.
Right. Yeah. You see energy back above 100, crude oil back above 100. That definitely perks my interest quite a bit. The 2-year yield is something I watch a lot. It's quirky. I mean, I'm sure your viewers aren't going to be like, wake up and be like, what's the U.S. 2-year yield doing? Like, I get it. But, the 2-year is a good benchmark for where the Fed policy is going. If that heads back to 5, that means that not only no rate cuts, but then you start to talk about rate hikes again. So those are things that a strategist would watch.
We're kind of getting there.
Yeah. By the way, the 2-year yield in the United States has been up almost the whole year straight. And the stock market's been going up along with it. That's why I think that we don't need rate cuts necessarily to keep going higher.
Okay, let's use kind of the opposite scenario. What if we do get the rate cuts? Could that be then negative for the market because it means that the slowdown, all those factors, the growth factors aren't there?
Yeah. So a lot of people look at a rate cut as this like panacea, this if rates get cut, that's great for stocks. They'll just keep going up. Why are we cutting rates? That's the ultimate question, right? Why would the Fed want to cut rates? Is it a dramatic economic slowdown? Is it a crisis? Is it something that we didn't see coming? So don't think of rate cuts as like, oh, if they cut rates in the U.S., that's just great for the stock market. No, we don't know why they're cutting rates and what are they doing it in response to. They have plenty of room to cut rates, but I don't want them cutting rates because something blew up or some sort of a pocket of the financial world melted down. Be careful what we wish for on rate cuts a little bit.
All right, Michael.